Hello, dividend growth stock enthusiast. It's Colby, the DGI crab, and it is that time of the week. It is Sunday, where I'm going to be going over the list of 60 individual growth stocks that this channel focuses on to see where the value lies going into the trading week coming up here. It's always good to take some time on the weekend to just take a look at the lay of the land, see where things are sitting at, and develop a plan for the stocks that you are going to target in order to build up your passive income stream in order to get to financial freedom. I'm a dividend growth stock investor with the emphasis on the growth. I want to build up passive income that will increase year over year. Even when I get to the point where I'm not reinvesting my dividends anymore, I want to get raises every single year so I can enjoy my retirement and not have to worry about going back into the rat race no matter what is going on in the market. So that's the name of the game, you guys. Now, I'm not a professional financial advisor. The content of the channel should be considered primarily for entertainment purposes, and you should always do your own due diligence before you invest. And if you're new, listen, guys, this is an age-based investing channel here. So of those 60 stocks, they're all great. They're all blue chip companies, but depending on what your age and time horizon is, some of them are going to be better for you than others. So I've split them into 4 separate categories or tiers based on the age of the investor. Now, my personal allocation strategy that I live by religiously is I put 50% of all new money into age-appropriate ETFs. So I have automatic diversification in my portfolio regardless of what I'm emphasizing with my individual single stock purchases. I'm going to be targeting single stocks that are yielding 30% or more above their 4-year average yield. That is the buy zone for me, or at least the beginning of the buy zone. Now, I do have in this group of 60 my top 10 favorites. Those I will purchase if they are yielding just 20% or more above the 4-year average yield, because a lot of them just don't get to that point very often. Now, I'm going to remain within my age tier unless there is a stock in a different age tier category that is yielding 50% or more above the 4-year average yield. At that point, I feel like there's enough potential for both price appreciation and just getting the yield at such a nice high starting point that it's worth it to dip into the other age categories here and there. And then if there's not a buyable stock within my tier, and there's not anything in the other tiers that look like a great super cheap value, I'm not going to stop investing for the week. I'll just double down and put everything into ETFs that particular week because I want to keep building up that passive income regardless of what's going on with the individual single stocks. Now, if we pivot over here to the DGI Crab spreadsheet, we're going to take a look at the 4 different tiers, starting with Tier 1, the 18 to 30-year-old investors, where generally this group of stocks, you're talking about an average yield of about 1.5%, and obviously that can vary from stock to stock. And as a group, we want to get well above 10% year-over-year dividend growth. This age category has a lot of time in the market, so you want to get that aggressive year-over-year dividend growth because that is going to really snowball and create some serious passive income for you the longer that you are in the market. So not only do we've got 3 stocks here that are in the buy zone, we have 2 that are well above that 50% or more above the 4-year average yield. United Health firmly ensconced as the number 1 value, not only in this tier, but this is the most undervalued one of all 60 that this channel covers. No one else is even close to this range. United Health this past week just announced a dividend increase of about 5.25%. That is noticeably less than what they typically do, well below that 10% plus that we want to get on the dividend growth, admittedly. But what you're trading off here is you're getting a current day starting yield at just shy of 3%. I'm just, it's unbelievable. The starting yield on United Health is this high. Super blue chip stock, you guys. I know they're going through it. I know there's negative headlines in the news. This has been probably the worst year for United Health in the history of their company, certainly in the last 20, 25 years at least. And they're taking a beating. But 2024, they did a 12% dividend increase, and that was the lowest increase they had done in like 10 years. They usually even do higher than that. So we're going to take this wimpy dividend increase by their standards, but pair it with a really high starting yield because my opinion, I don't think that 5% dividend increases are going to be the long term norm for United Health. I do think that they get through this tough stretch. I do think that over the coming years, they're going to get back to doing 10% plus dividend increases, which means if you start piling it up now with the starting yield at nearly 3%, that's some serious compounding that you're going to be able to do. The 4-year average yield is 1.37%, you guys. That's how unbelievable this incredible share price drop is. If you were buying United Health when there weren't negative headlines and everything was, happy and joyous and all of that stuff, you probably would have been spending $550 to $600 a share. Right now, you can get it for $303. This looks like a no-brainer to me. Still on the Nike train, you guys, yielding comfortably above 2.5%. That's 93% higher than the 4-year average yield of 1.32%. Nike is eventually going to recover. I think I've got a lot of faith in the company. We'll just have to see how it goes. I don't know when or how long it's going to take, but this just seems to me like one of those stocks where you pile up a big position in it while it's down, continue to reinvest all the dividends, and the next thing you know, it's several years later and they get back to their normal double-digit dividend increases, and you've got this amazing starting yield that you started your position in or built your position up in. Big time wealth compounder. And then Nordson, guys, it was down in the 180s just a few weeks ago. It has recovered up into the 214 range. Still undervalued in my estimation. The dividend king is a great deal here just for the tier 1 category. UNH and Nike, just about any of the age tiers could go ahead and start adding it at these prices, I think. But Nordson's a really nice deal here for you young investors. Tier 2, age 31 to 41 years old. The starting yield in this group is going to be a little higher, 2.5%, 3%, somewhere in that range a lot of the time. We want to get high single-digit dividend growth here. So a little bit higher starting yield, a little bit slower dividend growth. This is the largest tier in the category. We've got 19 stocks here, only 2 officially in the buy zone in Target and Hershey, but they are both of that 50% or more undervalued. So another 2 stocks that it's open season on for these guys. Tier 1, Tier 2, Tier 3, Tier 4. Any of the tiers could feel free to add these and feel pretty darn good about it. Target yielding above 4.5%. They're trying to mount a bit of a recovery here, but it's been kind of slow going for them up to this point. Hershey has I've been on my soapbox about Hershey for like the last 6 months. I've built up a very nice position in Hershey. It is that my just got into my top 5 largest individual single stock holdings. Wasn't planning on that being the case a year ago. A year ago, I had a pretty small position in Hershey, but I've just been hammering it for months on end right now because I waited for several years just watching this stock, wishing it was cheap, and just very seldomly ever getting a chance to even dip my toe in the water on it. And I've gotten this really long stretch now where I've gotten to just add and add and add and add to it. Now, they did a just shy of 23% dividend increase in 2024. I'm expecting a lot less than that this year, admittedly. With the starting yield here comfortably above 3%, I can live with that. This is a very long-term hold for me. And then these 4 here in the yellow, not quite in the buy zone, but Next Era, American States Water, McCormick have all kind of been just dipping in and out of that buy zone. So like over the course of the week, if you invest like pretty gradually in your stocks, these are ones to maybe keep an eye on. And if they drop just a few dollars lower at some point during the week, pounce on it and then just sit back and wait. Right now at these prices, I am going to sit back and wait just a little bit. But NextEra, AWR, and McCormick, all 3 are stocks that I really love quite a bit, and certainly wouldn't turn my nose up at you if you were adding them at these particular prices right now. Tier 3, age 42 to 53-year-old investors, the starting yield gets a little higher. We're now more in that mid-3s to low 4s range. Growth rate starts to slow down a little more, probably more in the 4 to 7% year over year on the dividend growth. These are the ones that once you get up into your 40s, you're starting to get higher starting yield. not emphasizing the growth quite as much, but you're really making a push now to financial freedom at this point if you're in your 40s and you've been investing like this for a little while. So these are some just steady eddies that could really help speed up that process and help you get there, while those compounders that you've acquired in the younger years are just dividend reinvesting and giving you dividend increases. ADM, Pepsi, Hormel are the three in the buy zone still. Hormel, I mentioned this last week, the longer it stays here around the $30 range, the less appealing that the current day yield of 378 gets, because every single week this 4-year average yield goes up at least a basis point, sometimes two. And all that means, guys, it doesn't mean Hormel's a bad stock. It just means that this particular yield is starting to become more the standard than the aberration. So hopefully there's a recovery story here for Hormel. I'm still more than happy to add some to my position if I'm in this age category, but I'm certainly more excited about ADM at 4.3% and Pepsi at 4.38%. Pepsi here in bold is in my list of top 10 favorite dividend growth stocks. 53% off the 4-year average yield. This is the one that I remain the most excited about. I think for me it would be Pepsi is the one I'm the most excited about, followed by UNH, followed by Hershey. Those would probably be my top three just overall in this particular group of stocks. J&J, another top 10 favorite, not quite at that 20% mark. I got to get J&J down to more like 154. All right, guys, tier 4, age 54 and older investors. We want higher starting yield with these stocks, you guys. 5% on average, maybe 6, 2 to 4% year over year dividend growth. We don't throw dividend growth entirely out the window here, but we're certainly focusing more on higher starting yield. These high yielders in the entire nearly year-long history of this channel have just been on fire. None of them have traded particularly cheap. Realty Income at times has been close to the buy zone, but nothing here looks appealing to me as a buy right now, unfortunately, you guys. Okay, so top 10 favorite stocks. Just wanted to swing by here real quick just so you can see them all on one tab. This is my personal top 10 favorites, and these are the ones that I'll buy at 20% undervalued. Some of them, like Microsoft, I was telling you guys like a month and a half ago, when Microsoft's starting yield was just slightly above the 4-year average, when it was trading down at like 375, I was saying this is probably a time to just add Microsoft, you guys, and look what it has done since then. Microsoft just does not stay down in the dumps for long. So guys, the strategy for the week for me is going to look kind of like this. If I'm in tier 1, 50% of my money is going into ETFs, right? So I'd be putting 25% into S&P 500, 15 small cap, 5% dividend appreciation, VIG, 5% VYMI. VYMI, my only non-US stock investment, I do 5% VYMI across the board, all age tiers. Tier 2, same 4, different allocation, VIG, VOO, VBR. And then tier 3, SCHD, VYM, DHS are my 3 favorite ETFs for the tier 3 category. Different strategies, but they're all fantastic. And then tier 4, I've got some alternative investments in here. SPYD for my stock exposure. And then high yield bonds, preferred shares, MLPs, covered calls, and of course, international. I'm doubling down on the ETFs if I'm in tier 4 because there wasn't anything in tier 4 for me to buy. I'm not doubling down on my international ever. So I'd put a 5% allocation into Pepsi in tier 4. And then for tiers 1, 2, and 3, you guys, this would be my order of attack. Tier 1, UNH, Nike, and Nordson in my own category. Then I'd want to hit Pepsi, a top 10 favorite. And then Target, Hershey, and ADM in the other tiers, all 50% or more above the 4-year average yield, makes them buyable to me. So this would kind of be my order of attack. For tier 2, it'd be Target, Hershey in my own tier, Pepsi, and then UNH, Nike, and ADM from the other tiers. And then finally for tier 3, I'd hit Pepsi really hard here, followed by ADM, little bit of Hormel, and then dipping down Target, Hershey, UNH, and Nike. So guys, let me know what you're buying for the week. I've had a lot of these here on the channel for quite a while now, but I want to show you that dividend growth stock investing, it's about consistency and just continuing to hammer on deals when they are available, because eventually these stocks won't be cheap and some other ones will be. Email me questions at dgicrab@yahoo.com, and I'll see you next time, guys. Keep it